Hello and welcome to part 2 of this tax process for business mock exam walkthrough. I hope you found part 1 useful, and so within part 2 I'll be covering tasks 5 through to 8. Now if you have any questions at all about what I've covered so far in this mock, drop them in the comments below and I'll get back to you as soon as possible. And remember, if you do like the video, be sure to hit that like button and subscribe to the channel. Anyway, let's get into part 2 of this video. Right then, so task 5 is for 12 marks and this task is about verifying VAT returns. This task contains parts A through to C. Aggies Market Limited uses accounting software to calculate the VAT due to or from HMRC. No special schemes are used. The accounts assistant for Aggies Market Limited is reviewing the VAT return for the quarter ended the 30th of November 2023. Before passing it to the accountant for approval. Part A, identify whether the following transactions should be included in box 1. VAT due in the period on sales and other outputs, or box 4, VAT reclaimed in the period on purchases and other inputs. Of VAT to the 30th of November 2023. So it's basically a long-winded way of saying, should these transactions go in box 1 or box 4? So remember, box 1 is your output tax, so it's what we pay across to HMRC, and box 4 is our input tax, so what we're reclaiming from HMRC. So let's start at the top then. So fuel scale charges. So fuel scale charges go in box 1. They are a charge to the business. Effectively, it's to do with the fact that if you reclaim the VAT on your fuel for the business, but there is some personal usage, what they do is, there's different ways that you could do it. You can either only reclaim the VAT on fuel that was used for business, or if you don't do that and you just claim it all back, whether it's personal or business, you can do it by charging a fuel scale charge, which is a certain amount based upon the CO2 emissions of your vehicle, and you pay that to HMRC, and therefore it goes in box 1. We then have VAT on bad debts. So VAT on bad debts is you effectively reclaiming the VAT that you would have previously paid on the sale of goods or services. However, that particular customer has not paid, and therefore what HMRC allow you to do is, because you never got that money in the first place, they allow you to claim it back. To be able to do that, it does need to be over 6 months overdue, and you need to write it off in your accounts, and then it would go in box 4 as part of your reclaim. VAT on cash sales, nice and straightforward. It's output tax, it's VAT that we need to pay to HMRC, and therefore box 1. And then the last one, VAT on credit notes issued to customers. So initially the amount on the invoice would be output tax. It's a sale to a customer, therefore we would have to pay it across to HMRC. However, if we then issue a credit note, that is reducing that amount down. So it's like if a customer returned the goods, or say they didn't actually want them anymore, you would therefore issue a credit note. It reduces the amount that they owe down to 0, and it would also reduce the output tax that would be paid to HMRC based upon that sale back down to 0. So it would go in box 1, but it would go in box 1 as a minus figure to reduce the output tax down on the initial invoice. So that would be box 1. Okay, moving down then. The accountant for Aggies Market Limited did not carry out her reconciliation of the previous quarter's VAT return as she was off ill. The accountant has discovered 2 differences which have been incorrectly reported and submitted in the previous quarter's VAT return. Difference 1, a payment to HMRC for VAT totalling £3,525.28 has been accounted for as input VAT. And then difference 2, a sales invoice which included VAT of £7,370 has been recorded twice. Part B then, complete the following statements about the 2 differences, 2 marks, so 1 mark for each box. So difference 1, input tax has been, and we need to select between overstated or understated. So let's have a look at difference 1. So a payment to HMRC for VAT totaling £3,525.28 has been accounted for as input VAT. So effectively what's happened there is that the payment to HMRC, so in the previous return, there clearly was more output tax than input tax. The amount that needed to be paid across to HMRC was accidentally put as input VAT. So therefore, as it shouldn't have been input tax, it would have therefore been overstated. Okay, because we've put too much input tax in. So difference 2, it says output tax has been, and again it's either overstated or understated. Now let's have a look at difference 2. A sales invoice which included VAT of £7,370 has been recorded twice. So fairly straightforward this one. They're saying that a sales invoice of which the VAT would go to output tax has been recorded twice. So we've basically entered in that 7,370 VAT amount twice into our output tax, into our box 1. Therefore, output tax would have been again overstated because we've recorded it twice. Okay, both fairly nice ones those. So moving on. Part 2 of B then, calculate the value of the net difference from the previous quarter. Enter your answers to the nearest penny. Okay, so we have output tax that has been overstated and input tax that has been overstated. That does make this one quite simple because all we need to do is the difference between the two amounts. If we think that output tax, so box 1, has gone over by 7,370 and box 4 has gone over by 3,525.28, the difference between the two is your net difference. Okay, so all we would do, one minus the other, and that gives you a difference of £3,844.72. Fantastic. Okay, moving down then. So the net difference will, and we need to select from either decrease or increase, and then select from input or output tax in the current quarter to the 30th of November 2023. So basically it wants to know, are we increasing or decreasing our input or output tax? Now it's important to know when we're correcting an error from a previous period, we will only ever increase. We never ever decrease box 1 or 4. I'll repeat that again. When we are correcting an error from a previous period, we never decrease box 1 or 4. We only ever increase. Okay, that is different if it is from the current period, but when it's from a previous period, we only ever increase. And we increase the net amount of any errors. So we will be increasing the £3,844.72, and we need to select whether that will be an increase to input or output tax. Now, considering our output tax was significantly more overstated than our input tax, to correct this net difference of 3,844 will therefore need to increase our input tax. Okay, so we're going to increase the net difference of £3,844.72 to the lower of the two, i.e. output tax or input tax. Now, because in this example, our input tax is the lower of the two, we would therefore increase this by the net difference. Brilliant. Moving down then. The two differences identified by the accountant are classed as non-deliberate careless errors. The box 6, so the total value of sales and all other outputs excluding any VAT figure for Aggie's Market Limited totaled 955,000. Part C, identify the reporting threshold for separate reporting of non-deliberate errors for Aggie's Market. Okay, so we actually get given this information within our references. So I'm going to bring that up. So it states up here that the reporting threshold is either 10,000 or, okay, so it has to be below 10,000 or, importantly, up to 1% of the total value of sales and all other outputs. Okay, and that goes to a maximum of 50,000. So what we would do for this particular question, we would first calculate 1% of our box 6 figure, so 955,000. And if we do 1% of that figure, that gives us £9,550. Now the reporting threshold is either 10,000 or up to 1%. And we pick the higher of these two figures. Okay, so we've worked out that 1% of 955,000 is 9,550. But because 10,000 is higher than that 1%, then the maximum reporting threshold would be 10,000. We always pick the higher of the two figures. So if, for example, I don't know, the box 6 figure was 1.5 million, I'm just throwing that figure out there, then 1% of that would be 15,000. So the reporting threshold would then be up to 15,000. Okay, we always pick the higher of those two figures. We can now close down our reference material and scroll down to the last part of this task. So part 2 states identify the correct action that the accountant of Aggie's Market Limited must take to report errors below the threshold. And we know this is below the threshold because the error, the net difference of the errors, is 3844.72. So way below our reporting threshold of 10,000. So basically we need to decide what should they do with it. Now we can never amend the previous VAT return, that's gone and submitted, so that's never going to be the right option. Now we're in the next period now, and because it's below the reporting threshold, we can correct the error in the now current VAT return. So that would be the correct option, but let's just double check the last one as well. So the last one states report the errors to HMRC in writing or using form VAT 652. So that is what we would have to do if it was above the threshold. So we've said the maximum threshold for this company is 10,000. So if the error was above 10,000, we would need to report the error to HMRC in writing or use VAT form 652. However, because it's below that threshold at £3,844.72, we could simply correct it in the now current VAT return. So that finishes off task 5. Let's now move on to task 6. So then task 6 is worth 11 marks and is about VAT rules on record keeping, filing and payment/repayment, including non-compliance implications. This task contains parts A through to D. You are working as a trainee in an accountancy practice, Alp Textiles Limited. A client started to trade on the 1st of August 2023 and registered for VAT on that date. Alp Textiles Limited has not registered for any special schemes. The first VAT return is for the period the 31st of October 2023. Part A, select the due date for the VAT return for the period to the 31st of October 2023 for Alp Textiles Limited. Right then, so if their VAT return is for the period to the end of the 31st of October, and you get a month, so 1 month and 7 days following the end of the period, that would take us to the 7th of December 2023. Nice easy start. So the next one, the directors of Alp Textiles Limited understand that certain business records should be retained according to HMRC rules. Part B, identify which one of the following business records does not need to be retained by Alp Textiles Limited for VAT purposes. Okay, so first one, correspondence from the bank about a personal loan for the director. So that would not be needed, so it should be this first one, but let's just check the others as well. So details for sales orders from customers, definitely need to keep those because they would have output tax on them. Documents relating to the purchase of goods, definitely need those because they'd have input tax on them. And bank statements of the business, we would need those to reconcile what had been paid to HMRC or claimed back from HMRC. So it would be the first one for which we do not need to keep the records for VAT purposes. Obviously, they would still need to keep the records, just not for VAT purposes. Next one then, identify to which year Alp Textiles Limited must keep the business records for the VAT period ended the 31st of October 2023. So the current rules are that we keep VAT records for the current year, so the current year plus 6 years. So it would therefore be for 2023, so we'd keep them all from this year, and then we would need to keep them for a further 6 years, which takes us up to 2029. Okay, all good so far. So part 3, identify the consequence for Alp Textiles Limited if VAT records are not kept for the required length of time. So we can either have a notice of assessment would be issued. Well, that wouldn't be correct. That's not what happens. A penalty may be issued. That would absolutely be the correct one for this. So if you don't keep your VAT records, you can be issued with a penalty from HMRC. And then the last one, just double check, the VAT registration would be withdrawn. That's definitely not correct. Okay. Moving down, the directors of Alp Textiles Limited decide to submit the VAT return for the period to the 31st of October 2023 themselves to save money. It's a big risk. The VAT return is submitted late and shows that VAT refund is due. So part C, identify whether the following statements are true or false. So 1 mark for each. Statement 1, Alp Textiles Limited will receive 4 late submission penalty points. That would definitely be false. I mean, they'd only receive 1. However, from what I remember, this was their first VAT return. And remember that there is a HMRC rule to say that they do not receive late submission penalty points if it is a business's first VAT return. So that would definitely be false. The next one, Alp Textiles Limited will not receive any late submission penalty points because there is no VAT due. So that one would absolutely be false. Just because there's no VAT due, that is not the reason why they would not receive any late submission penalty points. You still receive as a business penalty points if there is either a nil return or there's a VAT refund due. It doesn't make any difference. If you're late submitting it, you would still receive penalty points. And then the last one, Alp Textiles Limited will not receive any late submission penalty points because this is their first return. So that is what I've just spoke about. So that would be true. Okay, so they have a few rules on this HMRC. So you don't get late submission points if it's your first VAT return, and you also don't get one, I believe, when you're closing down the business as well. So if it's your final VAT return, once you've finished your VAT registration, whether that be that you're closing down the business or deregistering, if it's your final VAT return, again, you don't get a late submission penalty. So moving down then, so another client is Bexley Limited, for whom you prepare and submit quarterly VAT returns. Due to changing bank accounts, Bexley Limited have not paid payments to HMRC for the last 2 VAT quarters, as the direct debit has been cancelled. Today's date is the 22nd of December 2023. Part D, select the first and second late payment penalties that will apply to Bexley Limited for each of the following VAT quarters, where the returns have been submitted on time, but the payments have not been made to date. All penalties have been calculated to the nearest pound. So 4 marks, 1 mark for each box. So we can see that we've got 2 VAT quarter ends, the end of June and the end of September. We've been given the VAT due and the number of days overdue these payments were made. And we need to determine what would the first late payment penalty be and what would the second late payment penalty be. So again, let's draw on our reference material because it's super handy in this scenario. So here you can see we've got the late payment information that is provided to you in the actual exam. So we can use this to help calculate both our first late payment penalty and second late payment penalty. Okay, so first let's have a look at this top line for the VAT quarter ending the 30th of June 2023. So we've got VAT due of £5,100 and it is 137 days overdue. So obviously that is rather overdue. So we need to first have a look at our options. We've got first late payment penalty period and we've got 4 options. So all we need to do is have a look at our table here. So number of days overdue. So we've got up to 15, 16 to 30, 31 or more. So this is definitely in the 31 or more category because it's 137 days. With that in mind, let's calculate our first late payment penalty. So it would be 2% of the VAT outstanding at day 15 and a further 2% on the VAT outstanding at day 30. So all in all, 4%. So all we would need to do to calculate our first late payment penalty is do our VAT due of 5,100 multiplied, and you can either do this by 2% and then 2%, or quite simply just do 4%. So if we did £5,100, which is the VAT due, multiplied by 4%, that would give you a payment penalty of £204. So in our drop down, we should have one, which we do, for £204. Now the second late payment penalty states a daily rate based on 4% per annum, so 4% for the year, charged every day from day 31. So from day 31, so that would include day 31 until paid in full. Right, okay. So to calculate this, all we would do is take our VAT due and we would do 4% to start off with because it's a daily rate based on 4% per annum. So we need to first do 4%. Now we've actually just done 4%, so we know that that amount is £204. We then divide that by 365 because that's for the whole year. Okay, so we divide it by the full 365 to get the amount per day, and then we multiply it by the number of days due less 30. Okay, because remember, this starts counting from day 31. So we don't want to take off 31 days because it would start on day 31. So to get the number of days, it would be 137, so the overdue days, minus 30. Okay, so this second late payment penalty would have started on day 31, and because it's 137 days overdue, we do 137 less 30 to give you 107 days. So this second late payment penalty needs to be based upon 107 days. So just recapping the calculation, it would be £5,100 times by 4%, which is the second payment penalty for the whole year. But then we pro-rata it for 107 days because it only starts from day 31. So it would be 5,100 times 4% divided by 365 times by 107. And that gives you a second late payment penalty of £60. Bear in mind, it does state in the question, all penalties have been calculated to the nearest pound. So we'd round up because it's close to 60 and therefore £60. Now on your next one, this is for the VAT quarter ended the 30th of September 2023. The VAT due is £2,700, but this time it's only overdue by 45 days. Still, however, in this last category, which is 31 or more days. So same process for the first late payment penalty. It would be 2,700 multiplied by 4% because it's over 31 days overdue. So 2,700 times 4% gives you a first late payment penalty of £108. Now the second late payment penalty, it's the exact same process. So again, we would do 2,700 times 4% divided by 365 to get the amount per day, and then multiplied by the overdue days minus 30. Okay, so we wouldn't multiply it by 45 days because we know that this starts from day 31. So it would be 45 days less 30, so it's only 15 days for this second late payment penalty. So it would therefore be 2,700 times 4% divided by 365 multiplied by 15. And that gives you a second late payment penalty of £4. Okay, so we can now close down our reference material, and that does finish task 6. They are quite tricky, those, but my advice, like I said, would be to use the reference material. That's so much information to remember, so use it, you get it in your exam, just makes perfect sense. Now that does finish off task 6, so we can now move on to task 7. So then task 7 is for 12 marks and is about principles of payroll. This task contains parts A through to C. Part A, match the definitions below with the correct term for 4 marks, so 1 mark for each correct term. So we can see that we've got the definitions in the table here, and then we just need to select the correct term from the drop-down boxes on screen. So the first one then, the total earnings of an employee for a pay period after tax-free deductions. So this is describing once the pension amount has been deducted, and it describes the taxable gross pay. Next then, the total earnings of an employee for a pay period. So this describes your gross pay. So gross pay is before we take off any tax-free deductions. The only one you'll be dealing with in your exam is pension contributions. There are a couple of others. However, it's not something that you will have to deal with in your level 3 studies. The next one then, the amount earned by employees per hour. So that would describe your pay rate. So that's the amount earned, it's literally the definition that's there. It's the amount earned by an employee per hour. So if you were paid on an hourly rate, then that would be your pay rate. Then the last one, the amount an employee receives in their bank account for a pay period after all deductions have been made describes somebody's net pay. So if you think about your pay slip, think about the deductions that are made, such as your national insurance, income tax, all of that, which I'm sure we'll be coming on to shortly at the bottom when we usually have to do the calculations, then we know that that end figure that you actually receive into your bank account is your net pay figure. Okay, so nothing too complex to start off with. Let's scroll down. So part B, identify whether the following statements about registering as an employer are true or false. So 2 marks, 1 mark for each statement. So only businesses are required to register as employees, not individuals. Ooh, that would be absolutely false. So remember, even as an individual, such as a sole trader, if you employ staff, you need to register as an employer. It doesn't matter that you're a sole trader and not a limited company. If you have employees, you need to register as an employer. And then the next one, registration as an employer cannot be more than 2 months before employees are first paid. That's absolutely true. Not a great deal to add to that. It's just one of the rules on HMRC. If you have a look, you type in about registering as an employer, and it will explain on there that you cannot register more than 2 months before the point at which you pay your employees, or the first time you pay your employees is probably a more accurate description. Brilliant. So moving down, Sunday's Bakery is a partnership and it employs 1 member of staff, Desi, who reduced his hours from January 2024. Sunday's Bakery pays HMRC monthly and is entitled to the employment allowance. Below are some details from Desi's pay slips for December 2023 and January 2024. And we can see here that we've got pay slips, so we've got gross pay, income tax, we've got our national insurance, we've got the pension contributions and student loans. We've basically got absolutely everything that we could get on this one, so that's great to use as an example. So it also states underneath the employment allowance for Sunday's Bakery for December 2023 is £199, and for January 2024 it's £33.40. So remember, the employment allowance is deducted from the employer's national insurance contribution. So let's have a look what we need to do then. So part C, complete the table below to show the taxable gross pay and net pay for Desi and the amount payable to HMRC by Sunday's Bakery for December 2023 and January 2024. Enter all figures to 2 decimal places. any amounts repayable from HMRC should be shown as a negative figure using a minus sign. And it does look like that's going to come into play because we've got income tax here as a minus. So it's a refund from HMRC. So it does look like that may come into play at some point. So let's have a look what we need to do then. So we need to calculate the taxable gross pay, the net pay, and the amount payable to or from HMRC for the months for December 2023 and Jan 24. Okay, so let's have a look at each of these and calculate them. Hopefully nothing too complex. So taxable gross pay, so we spoke about this at the beginning of the question. So your taxable gross pay is your gross pay less any pension contributions, and it's specifically the employee pension contribution. So for December, it would therefore be the gross pay of £2,200 minus the employee pension of £90. Giving you a taxable gross pay in December 2023 of £2,110. And remember, it wants it to 2 decimal places, so it's 0.00. Then your taxable gross pay for January would again just be your gross pay minus the employee's pension contribution, so £1,000 less £90, to give you taxable gross pay of £910. Now our net pay is calculated as our gross pay minus income tax, employees' national insurance, so not employers, but employees' national insurance, employees' pension, again, not employers, employees, and student loan. So gross pay, less income tax, less employees' national insurance, less employees' pension contribution, less student loan. And that will give you your net pay amount. So for December 2023, it would be £2,200 minus £212.40 minus £138.24 minus 90 minus 32. And that gives you a net pay figure of £1,727.36. We can now do the same for January 2024. So the gross pay is £1,000. The only difference here is that we do have a reclaim on the income tax. So rather than minusing it off, actually this time we would add it to the gross pay. So it would be £1,000 plus £27.60, and then we can minus off the other figures. Now they don't have any employee NI, but they do have pension still. So for this one, and just to say they don't have student loan, it would simply be £1,000 plus £27.60 minus 90 for the pension contribution. And that gives you a net pay figure of £937.60. Then last on the list, we have the amount payable to or from HMRC. And this is calculated as your income tax plus your employee NI plus your employer NI minus your employer's allowance, your employment allowance, plus student loan. So in this example, for December 2023, it would be £212.40 plus £138.24 plus £199 minus the employment allowance of £199, so that nets off against the employer's national insurance, and then you would add on the student loan of £32. And that will give you an amount payable to HMRC of £382.64. Now for January 2024, this again would be your income tax plus your employer's NI less the employment allowance, and again add student loan. Now our student loan is 0 and our employee's NI is 0. And because the employment allowance of £33.40 nets off against the employer's NI contribution, again £33.40, that comes to 0. So actually the amount payable would be 0, and actually they would have a reclaim of £27.60. Now it does state in the question any amounts repayable from HMRC should be shown as a negative figure. So we need to show this as minus £27.60. So that finishes part C and indeed task 7. So I know people do struggle with those, and I think once you've done a fair few examples, you should be relatively comfortable. I don't see any curveballs being thrown in. I think once you know it, but I know it takes a little bit of time to get to that point. But once you're there, it should be absolutely fine. So we can now move on to task 8, which is our last task within this mock. So task 8 is worth 8 marks, appropriate, and this task is about reporting information on VAT and payroll. You are a trainee accountant at Dory & Co Limited. Your main responsibility is to prepare and submit VAT returns for numerous clients. You have prepared the VAT return for VC Dry Cleaners Limited for the quarter ended the 30th of June 2023. Extracts from the accounting software show the following. And we can see we've been given output tax, input tax, and then outputs and inputs. So basically box 1, box 4, box 6 and 7 figures. It then states all previous VAT returns have been submitted and paid on time. Part A then, complete the email below. When completing the dates, you must enter the year in full, so 2001 for example. So let's have a look at this email and what we need to do. Dear Mr. Carmichael, please find attached a copy of the draft VAT return for the quarter ended the 30th of June 2023. The return must be submitted to HMRC by... So we had actually got one of these earlier, so we know that a submission needs to be done 1 month and 7 days after the end of the VAT quarter, which means this must be done by the 7th of August. And in terms of the year, it would be 2023. The amount due to HMRC for the quarter is, and we need to calculate this based on our output tax and our input tax. So it would quite simply be our output tax minus our input tax, and that would give us the amount due to HMRC for the quarter, which works out to be £4,991.08. So to get that, it was literally just our output tax of £5,300 minus our input tax of £308.92. Next then, it states if the VAT return is not submitted on time, you will be liable to, and we've got to select from 4 different options, so either a penalty of £200, £400, or then the late submission payments. So as it states, all previous VAT returns have been submitted and paid on time, and it is not their first VAT return. If there were to be a late submission, it would simply be 1 late submission penalty point. The next bit then, all late payments of VAT are subject to, and we need to select from either late payment interest, which is sounding great. Late payment interest and penalties, we'll know because we get a certain amount of points before we get into the penalty system. And then the last one, late payment penalties, which again, because we get the penalty points before the point at which we need to pay penalties, the answer to this one would be late payment interest. You can actually find the information for this within the reference material on the right-hand side if you do need it. So then the next part states, please confirm that. And we either want all figures are correct, the figure for outputs is correct, the figure for output tax is correct. Well, obviously, if we're getting confirmation from someone, we want confirmation that all figures are correct. We wouldn't want just one figure to be correct. We need to make sure that everything is correct. So we'd want confirmation that all figures are correct. Okay, so that finishes the email. Let's now scroll down. So part 2 then, identify when the VAT return for VC Dry Cleaners Limited can be submitted to HMRC. So 1 mark for the correct answer. So it's either as soon as you have prepared the return, well, we're asking for confirmation, so that wouldn't be true. We've then got once authorisation has been received from the directors of VC Dry Cleaners Limited. Well, because it is the client's responsibility still, even though you're the one completing the VAT return, the overall responsibility is still on the business itself. So it would be this option, but let's just check the bottom one. So once your manager has reviewed the return, so yes, they would need to review the return and sign it off. However, ultimately, because the responsibility falls to the owners or directors of VC Dry Cleaners Limited, you wouldn't submit the return until they'd signed it off themselves. So it would be option 2. Scrolling down, you have established that the flat rate scheme may be more beneficial for VC Dry Cleaners Limited. The relevant flat rate percentage is 12% and the business is not a limited cost business. Part 3, calculate the amount of VAT that would be due if VC Dry Cleaners Limited were registered under the flat rate scheme, ignoring the 1% discount that you would get in your first year. Enter your answer to the nearest penny. So when we're calculating a flat rate percentage, it's done on their revenue figure. And remember, it's done on the total revenue figure, including VAT. So what we would need to do, let's scroll back up. And what we want to do is calculate firstly the total revenue figure, including VAT. So to get that, it would be our outputs, which remember is the net, plus our output tax. So it would be 26,500 plus 5,300. We would then apply our 12%, which is our flat rate percentage, to this figure, and that would be the amount of VAT that would need paying to HMRC. So if we do 26,500 plus 5,300 to give us our total or gross revenue figure, multiplied by 12%, which is stated here is the flat rate percentage, that would give you a VAT amount to be paid of 3,816. And as it states, enter your answer to the nearest penny, because it works out exact, it would be 0.00. So you would still need to put those in, just because it does state enter your answer to the nearest penny rather than nearest pound. So 3,816.00. And then the last question, identify what course of action you should take with your findings. So we can either discuss the matter with your line manager, do nothing as the client has responsibility for changing schemes, or request that HMRC change the scheme. So firstly, let's just have a look. So under the flat rate scheme, they would pay 3,816, and they're currently paying for this last quarter £4,991.08. So within specifically this quarter, they would have paid less VAT if they were under the flat rate scheme. So it's definitely something to be considered. Now, obviously, you couldn't just make that decision, so we can instantly rule out this bottom one. We definitely wouldn't do nothing either, because although they have overall responsibility, it is still your job or part of your role to advise the client if something would be more tax efficient for them. So the correct answer would be discuss it with your line manager. Okay, and that finishes task 8 and finishes off this mock exam. So that wraps up this mock walkthrough. Remember, if you have found this video useful, to drop it a thumbs up and subscribe to the channel for more AAT content. Thanks again for watching. I'll catch you in the next one.